Billions in gold just stopped moving. For decades, West African wealth flowed into Western vaults, yet within months that pipeline was abruptly disrupted by one policy. What does that mean for you if Ibrahim Traore is right? Because the aftermath could reshape everything. You are about to hear an explanation most public briefings carefully avoid because it exposes the structural mechanics behind a major geopolitical shift. You will gain a clear lens to interpret power moves others misread. This is not casual information. Ignore this moment and the situation may look like another routine dispute between nations, something distant and technical. And it becomes easy to accept simplified narratives built for comfort rather than accuracy. Overlook the signals now, and later developments may seem sudden or confusing when they were actually predictable. And in situations involving resource control, anticipation often determines who adapts and who is left reacting after the balance has already shifted. The first reality is this: the disruption is real, measurable, and already underway. In the first quarter of 2026 alone, metric tons of physical gold reportedly bypassed traditional European trading hubs and moved directly into state reserves, signaling a structural break rather than a temporary fluctuation. That single shift is why analysts began reassessing Ibrahim Traoré far more seriously. To understand how this began, attention turns to the underlying system that shaped West African resource flows for decades. Foreign extraction firms historically operated under agreements allowing them to remove large volumes of gold while paying tax rates often reported in the single digits. This created a pattern where a country ranked among Africa's top gold producers still saw much of its population remain economically strained. The turning point emerged after the 2010 military takeover that brought a young captain to power. Early reactions abroad framed the leadership change as another short-lived junta episode, yet the sequence that followed suggested longer planning. French forces were expelled. Regional alignment deepened through cooperation with neighboring Sahel governments. Each move alone seemed tactical. Together they formed a strategic trajectory. A brief example illustrates the shift. In one mining corridor previously managed by foreign operators, licensing reviews suddenly intensified. Within months, companies unable to verify compliance reportedly lost extraction rights. That localized action signaled something larger: the rules governing who controls underground wealth were being rewritten in real time. For observers tracking structural power, that was the moment the situation stopped looking temporary. One figure kept appearing in analyst briefings as a reference point for interpreting the shift: a regional security researcher who had spent years tracking resource conflicts across the Sahel. His credibility did not come from television appearances but from field data, contract archives, and interviews with mining administrators working inside disputed zones. When he compared recent policy enforcement patterns with earlier decades, he noted that enforcement intensity had changed faster than at any point he had recorded. He described one early incident that drew his attention. A foreign-operated site that had functioned uninterrupted for years suddenly faced a full compliance audit. Inspectors requested environmental records, export logs, and tax filings within a compressed timeline. The company failed to supply several documents. Within weeks, its license was revoked. The decision did not trigger chaos locally. Instead, operations resumed under new management aligned with national directives. For analysts, the significance was not the penalty itself, but the speed of execution. A second observation reinforced that this was not an isolated case. In another district, firms reportedly began renegotiating terms preemptively before inspections even reached them. Not reaction. Markets tend to notice when corporations change posture before regulations formally hit. From the researcher's perspective, the pattern indicated that Ibrahim Traoré was not improvising policy under pressure but implementing a structured enforcement phase designed well in advance. At that point, the situation stopped resembling routine policy reform. It started with a decree. Contracts rechecked. Audits launched. The shift was immediate. Before the policy, mining firms could extract and ship most output abroad with minimal friction. After it, companies were required to sell a significant share directly to the state in local currency. Phones rang, boardrooms reacted, legal teams scrambled, executives recalculated projections. Some firms paused shipments, others sought urgent clarification. The trigger phase had lasted only moments, but the reaction spread quickly across financial networks tied to resource flows. Pressure climbed, licenses reviewed, violations flagged, permits revoked, assets transferred. Each step landed faster than the last. Then enforcement notices, then ownership shifts. The tempo gave little room for negotiation. The response was simple. Replacement partners were invited. New players entered. Agreements rewritten. Profit splits adjusted. State share increased. The pace made the transition feel less like reform and more like a systems override. Regional governments watched closely because the implications extended beyond one country. If the model held, it could be replicated elsewhere. Then came the aftershock phase. But the consequences deepened. Some foreign firms reported lost contracts worth millions annually, traditional trade routes, or reduced volume. The immediate confrontation ended, yet its imprint remained embedded in market expectations. On the ground, however, a different residue formed. In several mining communities, reports indicated rising local optimism that resource revenue might stay domestically rather than leaving the continent. Policy effects can be measured in spreadsheets, but political durability often depends on whether citizens believe change is real. For many observers, that belief marked the true turning point. Numbers change how a story is judged. They strip away tone and leave only scale. In this case, the scale is what forced economists and policy analysts to look twice at what initially seemed like a regional policy dispute. One macro indicator stands out. Burkina Faso is widely described as the fourth largest gold producer in Africa. That ranking matters because it signals global supply relevance, not just local importance. A country position that high influences pricing expectations even when its output shifts slightly. A second figure reframes the speed of change. Reports indicate that in early 2026 alone, multiple metric tons of gold were redirected away from traditional European trading hubs and absorbed domestically instead. That movement reveals acceleration rather than gradual transition. It suggests the policy impact was immediate enough to alter established logistics flows. A third data point shows the human dimension. Prior arrangements were often said to involve foreign operators paying tax rates in single digits on extracted resources. That range implies limited public capture of national wealth. When citizens compare what leaves their soil to what returns through public spending, perception can shift quickly. In political economy is not cosmetic, it is catalytic. Taken together, these figures create weight. Production rank defines scale, redirected tonnage defines momentum, tax ranges define lived impact. When all three move simultaneously, analysts stop calling the situation symbolic and start classifying it as structural. And once a shift is structural, it rarely stays contained. It is important to recognize that not everyone interprets these developments the same way. Serious analysts, including economists and diplomatic observers, argue that skepticism toward the policy direction is not only reasonable but necessary. In their view, strong criticism is not hostility, it is risk assessment. That perspective deserves careful consideration before any conclusions are drawn. One major counterargument is that aggressive resource nationalism can frighten off long-term investment. From this standpoint, multinational mining firms bring technical expertise, infrastructure funding, and access to global markets that domestic systems may struggle to replace quickly. If too many companies withdraw at once, production efficiency could fall, export revenue could shrink, and the state could face fiscal strain before alternative partnerships stabilize. Historical precedents exist in several regions where rapid nationalization led to temporary output collapse. Supporters of this view therefore argue that caution, not speed, is the safer path. Yet available evidence complicates that concern. In the present case, reports suggest replacement partners began entering negotiations soon after earlier operators signaled hesitation. That behavior implies the resource itself retains enough strategic value to attract new stakeholders, even under stricter conditions. When demand for an asset is structurally high, leverage often shifts toward whoever controls access to it. A second criticism focuses on macroeconomic isolation. Some policy observers warn that redirecting exports away from established financial centers could limit liquidity access, raise transaction costs, and increase exposure to informal trading channels. They argue that integration into existing global systems, even imperfect ones, offers stability that parallel systems cannot immediately match. However, this critique may overlook a broader trend. The international financial landscape is no longer dominated by a single bloc, and alternative trade corridors have expanded in recent years. As more countries diversify partnerships, the cost of bypassing traditional hubs may not be as prohibitive as it once was. Under different conditions, function as realignment. When both perspectives are placed side by side, the picture becomes clearer and more nuanced. The policy path carries real risks, yet it also operates within shifting global dynamics that change how those risks behave. Understanding that tension is essential to understanding the situation itself. Everything pivoted right here. What shifted the trajectory was not another announcement or diplomatic statement, but a strategic possibility that analysts say sits beneath the surface of recent decisions. Observers studying regional coordination began noticing a pattern that pointed beyond national policy and toward something structurally larger. They might be laying groundwork for a monetary experiment. The emerging hypothesis centers on the idea of a gold-backed regional currency discussed within cooperative frameworks among certain Sahel states. If such a system were ever introduced, it would represent a major departure from long-standing monetary arrangements, tied historically to external guarantees. The logic is straightforward. A currency supported by physical reserves reduces reliance on outside financial approval and increases domestic control over issuance and policy timing. That possibility changes how earlier actions are interpreted. Measures that once looked like isolated enforcement decisions begin to resemble preparation steps. Stockpiling reserves becomes strategic positioning. Contract renegotiations become structural alignment. And if that interpretation proves accurate, then everything revealed so far may only describe the surface layer of a much deeper shift. The implications do not stay confined to policy runes or financial charts. Once a structural shift reaches this level, its effects begin appearing in everyday systems that people, institutions, and governments rely on. What started as a resource decision gradually translates into visible consequences across multiple layers of reality. At the state level, governing authorities suddenly operate under intensified pressure. Administrative agencies must monitor contracts more closely, enforce compliance faster, and respond to international scrutiny more frequently. When a country alters how strategic assets are controlled, its leadership inherits both greater autonomy and greater responsibility. For Ibrahim Traore, that means each regulatory decision is no longer judged domestically alone but evaluated internationally as a signal of stability or risk. Even a single licensing dispute can influence diplomatic tone or investor confidence. Businesses experience a different kind of shock. Mining corporations accustomed to predictable extraction frameworks must now reassess cost structures, legal exposure, and long-term planning assumptions. Some firms may delay expansion, others may renegotiate terms. Transport logistics and commodity trading adjust accordingly. Financial forecasts that once relied on stable export routes must be recalculated when those routes change direction or ownership. Uncertainty itself becomes a measurable cost. For ordinary citizens, the effects are more tangible and immediate. When resource revenue remains inside national borders rather than exiting through external channels, expectations rise quickly. Communities anticipate improved infrastructure, better services, and visible reinvestment. That anticipation can strengthen public morale if results appear, but it can also create impatience if benefits take time. Economic transitions rarely deliver instant outcomes, and when supply chains shift abruptly, temporary shortages or localized price increases may occur. These short-term frictions test whether public trust is durable or conditional. Beyond national borders, regional and global actors also adjust their calculations. Neighboring governments observe closely to see whether the model produces stability or strain. If it succeeds, it may inspire imitation. It may serve as a cautionary example. Meanwhile, international markets react to supply uncertainty with price volatility, particularly when a major producer modifies export behavior. Even distant industries that rely on gold for manufacturing or financial reserves can feel ripple effects when availability patterns change. Taken together, these layers show that the consequences are neither abstract nor distant. They move through institutions, companies, households, and alliances simultaneously. Once that kind of multi-level impact begins, the situation stops being a local policy story and becomes a development with systemic reach. Looking ahead, analysts generally outline 3 plausible trajectories that could unfold if current dynamics continue along their present path. And each depends on decisions made not just by one government but by multiple actors responding to the same evolving environment. The most probable scenario is a prolonged strategic standoff. In this outcome, policy enforcement remains firm. External partners adjust gradually, and trade routes reorganize rather than collapse. Economic friction persists but does not spiral. While alternative partners expand theirs, growth slows in certain sectors yet stabilizes in others. Under this path, Ibrahim Traoré's approach neither triggers immediate transformation nor systemic failure. Instead, it produces a drawn-out adjustment period resembling a localized economic cold competition rather than open confrontation. The optimistic scenario assumes coordination works efficiently and new agreements mature quickly. Replacement investors finalize deals, infrastructure adapts, and state revenue begins reflecting a higher share of extracted value. If that happens, early disruptions could be remembered as short transitional strain rather than lasting damage. The policy might be cited as a model showing that resource-rich states can renegotiate participation in global markets without losing operational continuity. The most severe scenario moves in the opposite direction. External pressure intensifies, investment inflows contract sharply, and security challenges strain national capacity faster than revenue gains can offset them. Under those conditions, administrative overload could weaken institutional resilience. Even well-intended reforms can falter if simultaneous economic insecurity pressures accumulate beyond what a system can absorb. The key point is not which scenario proves correct, but how prepared observers are for any of them. After seeing the broader landscape and the possible paths ahead, the most important question becomes personal rather than geopolitical. What does a shift like this actually mean for someone watching from afar, trying to understand events that seem distant yet increasingly interconnected with global systems? For those who actively follow international developments, early understanding is an advantage. People in this group tend to recognize patterns before they become headlines. That awareness allows them to interpret news with more context and less confusion when sudden changes occur. Because fast-moving situations can produce misleading signals alongside real ones, staying informed from credible sources becomes a practical skill rather than a casual habit. Another group feels the impact indirectly. They may not track policy announcements or commodity markets, yet their industries, investments, or daily expenses can still be influenced by shifts in resource flows or trade routes. The key is not constant monitoring but readiness. Understanding that global events can affect local conditions helps reduce surprise and improves decision-making when circumstances change. Then there are those who assume such developments have nothing to do with them. International strategy can seem abstract, distant, and removed from everyday life. History shows that large structural shifts often become visible only after they begin affecting ordinary routines. Ignoring them does not prevent impact, it only delays awareness of it. Whichever group someone belongs to, understanding the mechanics behind events like these offers one clear benefit. It reduces uncertainty. And in a world where uncertainty often spreads faster than information, that alone can be a powerful advantage. Real solutions cannot remain slogans. When structural economic shifts unfold, outcomes depend less on declarations and more on coordinated execution. So the practical question becomes straightforward: what concrete steps could realistically guide a transition like this towards stability rather than volatility? At the leadership level, success would hinge on disciplined implementation. Authorities would need to maintain transparent regulatory timelines, publish clear compliance standards, and enforce them consistently across all operators. The timeline for this kind of institutional stabilization is typically measured in years, not months. Progress could be evaluated through visible indicators such as contract compliance rates, dispute resolution speed, and steady revenue reporting. For Ibrahim Traore, the credibility of the strategy ultimately rests not on announcements but on administrative performance that observers can verify. For companies and partner organizations, adaptation would be the central task. Firms choosing to remain engaged would need to redesign agreements that align profitability with host country expectations. Stronger environmental documentation and localized reinvestment commitments. The effectiveness of these adjustments could be measured through operational continuity, production stability, and reduced legal conflicts. In complex sectors like mining, durability often signals that new rules have become workable rather than merely imposed. At the public level, the role is quieter but still decisive. Citizens influence whether policy momentum holds by responding to outcomes rather than rhetoric. Practical actions include monitoring visible development results, participating in civic dialogue, and evaluating whether promised improvements materialize. Public confidence can be tracked through turnout, community engagement, and independent surveys measuring trust in institutions. When people believe systems are functioning, stability becomes easier to sustain. If broader cooperation is added, regional coordination could reinforce progress. Shared standards among neighboring states, information exchange on resource governance, and aligned trade procedures would reduce friction and discourage regulatory loopholes. Synchronized policy announcements and joint infrastructure initiatives. Ultimately, execution determines everything. Strategies only shape the future when they are carried out with consistency, transparency, and measurable results. It is worth recalling the analyst mentioned earlier. The one who spent years studying resource conflicts on the ground and documenting patterns others overlooked. His observations were not dramatic predictions but quiet recognitions of change while it was still unfolding. That image: someone standing in a remote mining corridor, watching paperwork become policy and policy become power, captures how this entire story began to take shape. From the first disrupted shipment to the unfolding regional implications, the journey has traced a single arc. Control over contracts, control over reserves, control over decisions once made elsewhere. Along that path, Ibrahim Traoré has shifted from being viewed as a short-term political figure to a central actor in a much larger structural test. Whether one agrees with his approach or questions it, the scale of what is being attempted is no longer in doubt. Moments like this rarely announce themselves as historic while they are happening. They feel uncertain, incomplete, and contested. Only later do they become reference points analysts use to explain how systems changed. That is why the present phase matters. It is not simply about policy or markets, it is about the direction of influence and who molds it. Because sometimes history turns quietly before anyone hears it. Every viewer who has followed this far will take away something slightly different, and that is part of what makes discussions like this meaningful. Some may see a strategic gamble, others a calculated shift, and many will still be weighing the evidence. That range of interpretations is not a flaw, it is a sign that the issue is complex enough to deserve real thought rather than quick conclusions. If this story feels worth examining beyond headlines, it may also be worth letting others encounter it with the same context you now have. Conversations that spread understanding tend to be more valuable than those that spread noise. When more people grasp how decisions like these shape global systems, discussions become sharper, calmer, and more informed. So the question that remains is simple, and it does not demand agreement, only reflection. What do you think matters most in a moment like this, the risk being taken or the possibility being opened? And wherever you stand, you are not the only one thinking about it.